This is Dan Betzel. I want to thank you for taking the time to participate in my workshop and my webinar, Gearing Up for the Next Crash. Now, I don't know when the next crash is coming, but I will tell you the talk of a crash is in the air. Everywhere I go, almost everyone I speak with, both personally and professionally, is talking about the market, how it keeps going up and up and up, and oh my gosh, when is the next crash coming? Well, let me give you a little perspective. If you look at the graph, the S&P 500, which of course is just one index, but it shows the growth of $100,000 if you were invested back in January of 2000, and shows what happened, of course, at the bottom, which was at 3/31/2009, and how much that $100,000 would be worth today, or at least 2017. The $100,000 would be worth $257,886. So my goal for today is not to tell you when the next crash is coming or how bad it's going to be, because I, like everyone else, I have no idea. But what I do want to help you with is I want to help you transform the context of how you experience crashes or how crashes occur for you. Because my goal is to help give you the intellectual knowledge as well as the emotional fortitude that you'll need to galvanize against any negative effects that could happen in a market downturn. So, how many people have ever flown in a plane? My guess is that almost everyone has. And I recently in a podcast talked about an experience I had. I was flying from Tel Aviv to Chicago. I think it's about a 13-hour flight or so. And I was sitting next to somebody who at the time I didn't know, but I later learned was suffering from aerophobia. Now, aerophobia, or the fear of flying, is the sixth most common fear in the United States, and over 25 million Americans suffer from the fear of flying. But I think it might be misnamed. I don't think it's so much the fear of flying, it's like the fear of crashing. And there's a lot of similarities between the fear of flying, or the fear that comes from an airline crash, and the fear that comes from, say, investors who are invested in the market. So, but aerophobia has physical symptoms, and they include, sweating and trembling and increased heart rate, nausea, vomiting, and other forms of gastrointestinal distress. But probably even more potentially serious is the psychological symptoms that include irritation, dizziness, thoughts of falling to death, and inability to think clearly, and disorientation and nervousness. And it's the last couple, the inability to think clearly, the disorientation, and the nervousness that can really get someone into trouble. If they're suffering from, aerophobia, or they're suffering from portfolio phobia. So we've probably have all experienced times in a plane when you're experiencing turbulence. It's not fun. I recently, as I said, was on this long flight, and the pilot came on and told us before we took off, he said, we are flying halfway around the world, and it's not if we run into turbulence, but when. And that's so much like your portfolio. Your portfolio is designed to take you to the destination that you want for you and your family. And it's also designed to take into consideration the turbulence that not only you might experience along the way, but you will experience it. Now, when you're in the middle of it, I know all too well, it feels like it will never stop. But I'll tell you, it will stop, and it does stop. But nevertheless, when you're in it, you're convinced that it won't. But if you have a well-diversified portfolio, it's built to withstand volatility, just like a plane wing. Now, it wasn't in my last flight, but it actually was a flight I was flying across the country, and we were somewhere over the Rockies. And that's probably the worst experience of turbulence I've ever been in. The pilot had all of the flight attendants take their seats, discontinue the food and drink service. The plane was like literally listing from side to side, and it seemed like we were just going through all kinds of air pockets and dropping. And one time the plane, jilted to the left, and all of the oxygen masks came down. Of course, that created a little bit of a panic. The plane soon righted itself, and we were told we didn't need the We didn't need the oxygen masks. That just, I think the jerkiness of the turbulence had caused them to fall down. But yeah, there was a few minutes of like real fear. But when the pilot and the crew came on and said, stay in your seat, stay calm, keep your seatbelt securely fastened, believe me, I complied with their requests. But I was sitting close to the wing, and I looked back and I could see the wings, and it looks like they were just, being contorted, up and down and up and down. I thought, oh my gosh, looks like they're going to break. But of course they didn't. I want to show you a really interesting video. Now, this video takes place at an aeronautical engineer testing facility. It's outside of our country, but they're testing the strength of the wing. And this will be clear here in a second, but the actual T-bar here that's going to be pulling up on the wing, I want you to think of you by analogy, that this is you, right? And the actual wing, which you'll be able to see more clearly here in a second, that's your portfolio. So the portfolio, or the wing, is going to be put under a lot of pressure, and we're going to see what happens. Okay, here we go. Okay, it's very interesting what happened. As you can see, that the wing was under significant pressure, but the wing never broke. What broke was the T-bar. So the wing is like your portfolio. It is built to withstand the pressure, but the investor, we're human. We're like that T-bar, and under significant pressure, we can often break. I think it's a great analogy. It's something to hold into your mind, next time you're experiencing either turbulence in the plane or some turbulence in your portfolio. So we know that crashes happen, and we know that the fear is likely worse than any crash, but nevertheless, crashes can create some opportunities. And I want to go through these three areas here with you quickly. So first of all, what is a crash? Well, a crash stock market crash is a sudden, dramatic decline of stock prices across a significant cross-section of a stock market. Now, what do we mean by a sudden, dramatic decline? Well, using annual market performance, we looked at 20% or greater drops. Now, the S&P 500 has had three separate 20 to 29% calendar year drops since 1926. Well, the S&P 500 has had three separate over 30% calendar year drops since 1926. So what would that mean? If you were to experience this 30% drop, you had $1 million portfolio. Well, after the 30% drop, you would not have $1 million portfolio. You would now have how much? It would be 30% less, you'd have $700,000, right? So this is interesting, but there are 92 years between 1926, 1926 and 2017. And it's interesting that for 68 of those years, we had an up market of 21.12. This is in the S&P 500. It's just one index, but it's a good index for us to use for discussion. And 24 years, negative average of negative 13.61. So roughly 3 out of 4 years, the market is up. So 25% of the time, the market is going to be down. So what does this mean? If you were able to stay invested from 1926 to 2017, you'd have an annualized return of 10.16. Now, it's not going to be 10% every year. It's going to be sometimes significantly more and sometimes significantly less. But what this means is that if you had been able to stay invested, you would have been able to double your money roughly every 7 to 8 years. But in order to do that, in order to get that return, you would have to have been able to withstand the volatility. In order to fly to your destination, you sometimes have to go through some turbulence. But we know from that video we saw that the wing can withstand that. So the problem is that when the market is at an all-time high, people fear a pullback. And this is like a really interesting graph that I want to show you, because the media keeps talking about the market's at an all-time high, the market's at an all-time high. But let's put this in some perspective. I'm going to quickly be adding stars along this continuum from January 1985 to December 2017. And you're going to see there have been numerous all-time market highs, all-time market high, all-time market high, all-time market high, all-time market high, all-time market high. Do you see what's happening? That there's consistently over and over and over and over and over and over and over, I'm sorry to be so dramatic, all-time market highs. And at every single one of them, the media is saying, oh my gosh, an all-time market high, a pullback is inevitable. Well, on one hand, they're right. We know that roughly 3 times out of 4, the market is up. And 1 time out of 4, 25%, the market is down. So here, all-time high, all-time high, all-time high, another all-time high, another all-time high. And recently we've had nothing but one all-time market highs after another. And you can see that that to talk about an all-time market high is a bit funny, right? Because it's going to be inevitable because of how the market works. So what does this mean? This means that if you had invested $100,000 in 1985 on 12/2017, wow, your money would have grown $3.4 million. What does this tell us? It tells us that it is very, very important to be actively participating in the market, and that the real way to create wealth is time in the market and not timing the market.
So let's get right to it. In today's market action, we have Mark Matson, Matson Money CEO. He's going to tell you how to get the highest returns from your portfolios no matter what the market's doing.
Mark, we are closing today at a 14-year high for the NASDAQ. Wow. Let's marry what Scott Bauer said with how you feel about whether people should be in stocks.
Well, what happened was, in 2008, 2009, a lot of people got panicked out of the market, and they've been waiting for this period of certainty where they know for sure that it's safe to get in. But guess what? That period is never going to come. Just because we're at an all-time high doesn't mean anything about the near-term future.
Yes, so if you're waiting for certainty, you'll probably never be in the market. And people say, I hate volatility, but the truth is, they really don't hate volatility. They only hate downward market volatility. Everybody loves upward volatility. But remember, it's about 3 to 1, 3 years up, 1 year down, 3 years up, 1 year down. Now, it doesn't happen like that systematically. We never know what 3 out of 4 years are going to be up. But when we take a broad perspective, that's a really good rule of thumb to judge how the market acts. So one of the worst possible things an investor can do in a down market is panic and sell. So whenever we have a down market, we see a massive transfer of wealth. And basically that transfer of wealth is from those who can be disciplined and long-term investors. They're the ones who are getting the wealth, and the people that have allowed fear and pessimism and panic to say be the root for making some very poor investment decisions, they have a loss of wealth. So most people know that it's very, very important to buy low and sell high, but they don't do it. They often do the opposite. And in my experience, rebalancing is probably the hardest thing to do. Now, it's very easy to buy a diversified portfolio, but it's often very difficult to stick with it. So when the market goes down, things are on sale, but people run from it. I don't know any other sale where people actually run from it. They usually run to it. Now, if you have a portfolio that has been properly designed, and you understand the risk tolerance, and it's being managed properly, there is no reason that you would need to panic or fear or make changes just because there's some geopolitical or economic headwinds. The portfolio has been designed and is being maintained with that turbulence in mind, just like the airplane, just like the wing of the airplane that we saw in the video. And it's not the wing that breaks. It's often the T-bar. It's not the portfolio that breaks. It's the investor. So if you're not prepared now, it'll be too late once you find yourself in the turbulence. So take the time now to make sure that you understand your portfolio. It's designed with the right risk tolerance in mind, and you know how it's going to be managed in the event that turbulence, in the event of the turbulence that will come. So the crash is never the problem. Crashes happen. Well, it's fear is likely worse than any crash. And, there's this waiting for a correction can be very costly. I was just talking to someone who told me, I want to invest some money. I have $50,000 sitting over here in cash, and I want to invest some money, but I need to wait until the market, corrects, and I'm gonna get in when the market corrects at the bottom. Now this is a very complicated study in a slide. I'm not going to go through it in a lot of detail. If you're very interested in this, please contact me, and I will gladly spend time and help you dissect this slide. But it's based on the CAPE ratio, the cyclically adjusted price to earnings ratio. But what I do want us to get from this slide is that the longer you wait for a drop and the larger the drop you are waiting for, the higher the average cost or return loss. And it seems so counterintuitive. So in other words, if you wait 1% or for the market to be down 1% or 3% or 5% or 10%, and you try to get in then, if you had actually been invested in the market the entire time you were out waiting for the correction, you would have been better off. And that's what this chart shows us. So, another way of saying that is that it's actually time in the market and not timing the market. If you get that, you get the basic essence of this slide. So time in the market beats timing the market, as I said. So why is it then that we have, the S&P 500, which of course is once again just one index, giving us an annualized return of 10.16 for the years 87 to 2016, but the average investor is only getting 3.98. Why are they underperforming the index by 6%? Well, I think we know why that is. It's because they're engaged in, market timing, stock picking, track record investing, and unfortunately, they're letting the doomsday sayers of fear and pessimism cloud their judgment and have them make decisions that are not in their best interest. And we see the same thing not only in the equity market but also in the bond market. So investors, I hate to say, are still terrified of equities. There was a recent, I think it was in April of 2015, I believe it was, a survey that was done, and they asked, are you more inclined to invest in the stock market today than you were in 2009? And 76% of the people still said no. Only 20% said yes. Well, why is that? It's because of fear and pessimism sell. And when you turn on the TV, you you read a magazine, you download something from the internet, you're going to find that those articles, those videos that are talking about fear and pessimism, they are watched and viewed and shared and clicked on significantly more than someone who is touting the prudent investing, based on the modern portfolio theory and the three-factor model, as is espoused at the University of Chicago, by some of our country's leading Nobel Prize-winning economists. That doesn't sell. But, the all-time market crash that's going to destroy your retirement, unfortunately, that part of our brain is stimulated, and that's what gets focused on in the attention. So I want to play for you a little video about Mark Cuban. He's a billionaire. I think his net worth is worth $3 billion. And listen to his message, and then we'll see whether this obviously very smart man was able to time the market.
And then there's the uncertainty of the election. I mean, I have my Trump hedge on. In the event Donald wins, I have no doubt in my mind the market tanks. And so I literally have put on a more than 100% hedge.
Really?
That I'll put on stronger if it looks like there's a better chance.
What does that mean? Donald Trump wins in November. What is Mark Cuban doing?
Mark Cuban, if the polls look like there's a decent chance that Donald could win, I'll put a huge hedge on that's over 100% of my equity positions and my bond position as well, that protects me just in case he wins.
Well, the first thing, obviously, is Mr. Cuban is a very smart man, a great businessman. He's worth over $3 billion. Someone may have to maybe educate him. I'm not even sure he can do what he's proposing to do, but let's see whether his prognostications have come true. 11 2016 to 12 2017. What did the S&P 500 do? Well, $100,000 grew to $128,000. So, wow. But the fear and the pessimism, it's been around a long time. It didn't start with Mr. Cuban. Look at 1979 Business Week, the death of equities, how inflation is destroying the stock market. 1984 Time, that monster deficit, America's economic black hole. 2014, the death of money, the coming collapse of the international monetary system. I actually read that book. A friend gave it to me. And it was, wow, fear and pessimism, the end of life as we know it. And unfortunately, some people follow these magazines and these books, and they're not meant to give you peace of mind. They're not meant to teach you about investing. They're meant to use fear and pessimism to sell you something. 2009, How to Survive the Collapse of Civilization. Practical, low-cost strategies for coping with global epidemics, terrorist attacks, electrical grid disruptions, food and water shortages, and much more. I mean, oh my gosh. I find this next one pretty funny, but in 2010, a survival treasury, surviving a global financial crisis. And it's written by the same guy, right? The same one who did How to Survive the Collapse of Civilization, this Bob Livingston. Well, in 2018, you can buy the book now for 60% off. And if you think I'm joking, here's his website. Look, the book was selling at one time for $49.95. It's now selling for $19.95, 60% off. And I hate to say it, but I still think even at $19.95, it's a waste of money. I want to play you. So it's not only Mark Cuban, who's a businessman, trying to forecast the future and what's going to happen. But, Harry Dent. Harry Dent's been around a long time, written a lot of books. A lot of people follow his market predictions. And once again, we'll see that Mr. Dent really is not capable, is not qualified. There's no one who is qualified to tell us what the market's going to do, because no one is able to consistently and accurately predict the market. But here we go. Listen to this short video.
What is this? You keep saying crash. I mean, how significant a crash are you expecting? Haven't you been predicting this for years and it still hasn't happened?
Well, it's in the process of happening, and many of my predictions have come true. But we have to prepare ourselves for the fact that interest rates are going to go way up. And when they do, all those banks that we bailed out because they were too big to fail, they're all going to fail again. And this time, we're not going to be able to bail them out. The housing market isn't finished going down. It has to go down more, and the government cannot afford to pay the interest on the national debt, let alone retire it when interest rates go up. So we're going to have to come to terms with these massive macroeconomic imbalances of spending too much, of borrowing too much, of not producing enough, not exporting enough, not investing enough. All these things that the Fed is papering over with QE, we're going to have to deal with these problems. And they're much more massive today than they were in 2008. So if you thought that downturn was bad, you ain't seen nothing yet.
So that's June 2013.
We've had
June
financial problems in America, let's use America, every 4 to 7 years since the beginning of the Republic. Well, it's been over 8 since the last one. This is the longest, or the second longest in recorded history, so it's coming. And the next time it comes, you know, in 2008 we had a problem because of debt. Henry, the debt. Now, that debt was nothing compared to what's happening now. In 2008, the Chinese had a lot of money saved for a rainy day. It started raining, they started spending the money. Now even the Chinese have debt, and the debt is so much higher. The Federal Reserve, the central bank in America, the balance sheet is up over 5 times since 2008. It's going to be the worst in my lifetime too. Be worried.
Okay, so we see, you know, Mark Cuban and continually, you know, this message of fear and pessimism. Be worried. Well, if you had listened to these naysayers, these I guess media peddlers of fear and pessimism, what would you as an investor had missed? Well, I think you would have missed one of the most amazing growth in equities that we've seen. So the performance from the bottom of March 2009 to 2017, total return gross of fees, the S&P 500 up 338%, dimensional U.S. microcap up 430, dimensional U.S. large value up 408. And if we look at from 11/27 to 2017, the S&P 500 up 115%, dimensional U.S. micro up 135%, dimensional U.S. large up 95%. So what would you have missed? This is what you would have missed. So the growth of $100,000 from the bottom, 2009 to 2017, the S&P 500, your $100,000 would have grown to $438,000. Dimensional U.S. large cap value, 508. And dimensional U.S. micro, 530. That's what you would have missed. All because the media peddlers of fear and pessimism trying to wage a war for your mind and get you to react, to panic in a way that is not conducive to long-term, prudent wealth building and wealth creation. So, assuming you have a globally diversified portfolio, you know, what would it really take to destroy it? Now, if your portfolio is truly globally diversified with all 19 distinct asset categories, over 16,000 positions, you know, representing, you know, dozens of countries, you know, it's going to take something like, you know, a meteorite hitting the earth, or perhaps, you know, God forbid, you know, a global nuclear war, or, you know, maybe one of these guys showing up. I don't know. But my guess, if any of those things were to happen, the least of our concerns would be our portfolio. So the world is not ending today. And we know that crashes can create some opportunities. So we know crashes happen. Often the fear is worse than any crash. And if our portfolio is designed properly and is being maintained properly, and we have the right frame of mind, crashes can create some opportunities. So this is the opposite of what should happen, right? When the market is correcting. Betterment and Wealthfront websites crash during the market bloodbath. So this is back in February 2018. You know, the market was having some jitters, and all of the people that were on these websites, they were trying to get out and sell their positions as quickly as possible. So what were they doing? They were selling low, not high, but there were so many of them that were reacting to the panic, to the to the messages of fear and pessimism, that they actually crash the websites. So historically, one of the best times to buy equity is in a crash. Short-term market movements are random and unpredictable, right? No one can, with any accuracy, consistently predict market movements. Therefore, the appropriate prudent strategy is to own equity, to diversify, and rebalance. And we diversify using short-term fixed income. Every portfolio needs to have some short-term fixed income that can be used to offset market highs and market lows. So we have to remember that we're our own worst enemy. I want to play for you a funny clip from a movie that I remember back from my early high school days. I think you'll remember it once you see it, but it has to do with the long-term kind of destruction that can come from panic. Okay? So hope you enjoy this clip.
The life of everyone on board depends upon just one thing: finding someone back there who can not only fly this plane, but who didn't have fish for dinner.
Ladies and gentlemen, this is your stewardess speaking. We regret any inconvenience the sudden cabin movement might have caused. This is due to periodic air pockets we encounter. There's no reason to become alarmed, and we hope you enjoy the rest of your flight. By the way, is there anyone on board who knows how to fly a plane?
So her question, the way it was phrased and how it was articulated, obviously created some panic aboard the plane. Panic is that sudden, uncontrollable fear or anxiety, often causing wildly unthinking behavior like sword fighting or trying to beat up a nun. But inducing panic is against the law. Nevertheless, when it comes to the investment, let me call it investment pornography that we're often confronted with, there is a lot of how should I say it? There is definitely some interest in using fear and pessimism, and that can often result in panic. We reviewed some of those today, like the worst crash in a lifetime, or Mark Cuban, the market will crash, after the election, or other prognosticators telling us that, that the Dow is going to be trading at 6,000, 6,500. They're all participating, I think, in creating panic and mayhem in investors' financial lives. So in life, it never pays to panic. So what is this? You probably know that this is a flight simulator. And pilots, commercial pilots, they spend hours and hours and hours training for all the different possible scenarios that may happen during flight. Maybe weather, maybe mechanical failures, anything that can possibly be imagined. And they do that so that when they do find themselves in that situation, they've trained for it properly. They know how to react. And almost all the time, we know that planes arrive safely at their destination. So it's kind of like this workshop, this webinar. I'm really trying to, to put us inside of some sort of investor simulator where we can talk about crashes, because just like airplane pilots know they're going to run into bad weather, they know they're going to have off and on certain mechanical failures, and they need to prepare so that they know how to react. I want us to do the same thing as investors. I know we're going to face turbulence. I know there are going to be market downturns. I mean, we know the S&P 500 for 75% of its time is up, 25% of the time is down. We know we've had market crashes of over 20 to 29%. We've even had several over 30%. It will happen. How are we going to react? Are we going to do the necessary training now so that we react appropriately and we don't make decisions and don't take actions that are going to undermine the viability of our wealth creation in our portfolios. So panic is the enemy to prudence. It's the enemy to your dreams, and it's the enemy to your future. So what to do in the unlikely event of a crash? Number one is don't panic. Number two, understand that no one can accurately predict crashes. When someone tries to tell you that a crash is inevitable, I would question their authority and question their ability to accurately prognosticate that. So pick a portfolio you can truly live with, no matter what comes. That means you have to know how your portfolio is designed, and you have to know what its risk tolerance levels are. And you have to be willing to say yes to that portfolio in good times and in bad. So go to classes, educate yourself, talk to your advisor, stay focused on what is important.
Look, there are two things that affect the market going forward. There is rational movers, that's news, statistics, facts, and data. And then there are irrational movers, and that's emotions, instincts, and people just buying on fear and greed. Neither of those things are predictable in the future. No one has a clear sign on the new news, and no one has a clear sign on the emotions and people moving forward. That's why the market is perfectly random and unpredictable. But we know the long-term stint of the market is up, so we own the market. We don't try to bet and predict it. And of course, it's very possible that they're going to have good earnings and the economy is going to get better. I believe in freedom. I believe in the free markets. Entrepreneurs will take us out of this.
So let's look again at the growth of $100,000 from January 2005, with the star at the bottom showing the what would have happened if you had invested. We know that the market is going to have its turbulence. It's going to go up and down. But the $100,000, if you had stayed invested the entire time in the S&P 500, would have grown to $289,000. So we have survived crashes, and we will survive the next one as well. So look at the growth of $100,000 from 1092 to 2017 in the various portfolios. So isn't it interesting? The U.S. Consumer Price Index, 174,000. Income and growth, which is a very conservative portfolio. It's 75% fixed income and 25% equities. That $100,000 would have grown net of fees $255,000. Balanced portfolio, 50-50, 50% equity, 50% in the bond market, $393,000. Long-term growth, $541,000. MSCI World Index, $654, and the aggressive, $672,000. Okay, wow. So we can see the various dips in the market, the various crashes, we can call them. But nevertheless, if we have a longer view, we can see that we're rewarded for being disciplined and being patient, not panicking, not succumbing to the messages of fear and pessimism, and allowing the market forces in a well-designed and properly maintained portfolio create long-term wealth for us and our families. So my goal is to transform the context of how crashes occur for you, so you can galvanize against negative effects. Now, I want to show you a really fun little clip here, and it's used to illustrate, kind of like the herd mentality and how we often dial in to the messages of fear and pessimism that someone can possibly prognosticate and tell us what's going to happen. So I hope you enjoy this clip. It's pretty funny.
Oh, honey, I'm sure there's nothing wrong with the plane. All right, look, I have to go. I love you, and I will call you the minute I get to Paris.
What was that?
Oh, that was just my crazy friend. She told me I should get off the plane because she had a feeling that there was something wrong with the left phalange.
Okay, that doesn't sound good.
I wouldn't worry about it. She's always coming up with stuff like this, and you know what? She's almost never right.
But she is sometimes.
Wow. What are you doing?
Okay, well, I can't take this plane now.
Excuse me, sir? Where are you going?
Okay, I have to get off this plane, okay? Her friend has a feeling something's wrong with the left phalange.
Could I get some peanuts? What's wrong with the plane? There's nothing wrong with the plane.
The left phalange.
There's no phalange.
Oh my God. This plane doesn't even have a phalange.
working on it.
Ma'am, please sit down.
What's going on? We're all getting off. There is no phalange.
This is ridiculous.
So it's a humorous little clip, but that sometimes is how I've actually heard people telling me this is what they do. They're in the lunchroom and someone tells them that they heard that some stock is going to crash, and so they're going back to their office quickly so they can get out of that position in their portfolio, and the other person runs and does the same thing. And I'm like, oh my gosh, that's the opposite of, say, prudent, evidence-based long-term investing. Okay, so this is kind of interesting, but the chances of dying in a plane crash, look at that. It's 0.509%. Now, the chance of dying in a skydiving accident is 0.307%. Now, the chance of dying from jumping out of a plane that you think is going to crash, well, statistically, that's 100%. So I think that we know that even clients that have come on board since the last crash of 3/31/2009, you haven't lived yet through a crash with us, but we have. We know what to do, and we know how to manage the portfolios for the inevitability of the next downward turn. So look at this once again. S&P 500, growth of $100,000 from January 2000 to 2017. Wow, we can see what happens. It grows to $257,000. So, I don't know when the next crash is coming, but what to do in the unlikely event of a crash. First of all, realize crashes happen. It's nothing new. It's what every advisor understands. We design the portfolios with the crashes in mind, and we manage them. We manage the portfolios to take advantage of those downward pressures on the market, and that no one can accurately predict crashes, and that you need to pick a portfolio you can truly live with no matter what comes. Go to classes, educate yourself, call your advisor, and make sure that you're on the same page, and stay focused on what is important. Stay in the plane, because we know that statistically jumping out of the plane is 100% fatal. And if it's prudent, stay in your portfolio. I'm not saying you should never make changes to your portfolio. Of course, there are significant life events, perhaps retirement, perhaps unfortunately the loss of a spouse. I mean, there are events that tell us that it's time, it's appropriate, it's prudent to reevaluate our investment strategy. But you don't change your portfolio in reaction, to short-term economic or geopolitical issues, that are creating turbulence for you as you're trying to get to your destination. So I really hope this has been useful for you. My goal is that you will have a certain sense of peace of mind, of confidence amidst the storm, and that when you hear the messages of fear and pessimism, you will recognize them for what they are, and that they will not be able to induce you to panic and to fear and to cloud your judgment to make difficult, bad decisions for you and your family. So I wish you the best, and thank you so much again for taking the time. If you have any questions at all, please feel free to reach out to me either by email or by phone. Be more than happy to talk to you on the phone, answer your email, or of course meet with you in person. Thank you very much, and wishing you much peace on your journey toward financial freedom.